If you're just starting to invest, your biggest risk isn't losing money. It's making one small mistake at the beginning that you don't even realize and paying for it for the next 10 years. Most beginners don't fail because they lack intelligence. They fail because no one ever told them what not to do. In this video, I'll break down 15 investing mistakes beginners must avoid in 2026, divided into 3 key blocks: mindset, financial foundation, and technique and execution, so you can build your portfolio the right way from day one. Let's start with the most common mistake beginners make: waiting for the perfect moment to invest. Most people think they're being cautious. I'll invest after the next crash. I'll wait until the market feels safer. I'll start when things calm down. But the truth is simple. The market never feels safe when it's actually a good time to invest. During crashes, headlines are negative. During recoveries, people say it's too late. And during bull markets, people wait for a pullback that often never comes. Historically, markets spend more time going up than going down. And missing just a few of the best days can dramatically reduce your long-term returns. This is why trying to time the market doesn't just fail. It usually keeps people permanently on the sidelines. The real risk isn't investing at the wrong time. The real risk is not being invested at all. Time in the market beats timing the market. Waiting feels safe. But waiting is often the most expensive decision beginners make, because every year you wait is a year of compounding you can never get back. The next mistake is closely connected to the first one: following news and crash predictions. Beginners consume financial news thinking it will make them better investors. In reality, it usually does the opposite. News is designed to grab attention, not to help you build wealth. Fear sells, urgency sells, calm, long-term thinking doesn't. When markets are falling, headlines scream panic. When markets are rising, the media warns you it's too late. This creates a constant state of anxiety, and anxious investors make bad decisions. The problem is that by the time news feels dramatic, most of the damage or the opportunity has already passed. Long-term investing doesn't require daily updates. It requires a plan you can stick to, even when the noise gets loud. If your investment decisions are driven by headlines, you're not investing, you're reacting and gambling at the same time. The third mistake beginners make is constantly changing strategy. They start with one plan. Then they see a new video, a new post, or a new, better idea, and they switch. From ETFs to stocks, from long-term to short-term, from discipline to experimentation. The problem isn't the strategy. The problem is never giving any strategy enough time to work. Remember, timing in the market is getting one step closer to success. Investing is not about finding the perfect system. It's about sticking to a reasonable one for long enough. Markets reward consistency, not activity. And the more often you change direction, the more likely you are to buy high, sell low, and lose confidence. A boring strategy followed for years beats a brilliant strategy followed for months. The fourth mistake is following gurus instead of data. Beginners often look for certainty, and gurus are very good at selling it. They speak with confidence. They show results. They promise clarity in a complex world. But investing doesn't reward confidence. It rewards patience, discipline, and probability. Most gurus make money from attention, not from investing. Their incentives are clicks, views, and engagement, not your long-term results. Data, on the other hand, is boring. It doesn't promise shortcuts, and it doesn't need your trust and only your understanding. If someone is selling certainty, they're probably selling you a story. Long-term investors don't follow personalities, they follow evidence. The math is on your side, you just have to use it. This one is dangerous because it doesn't feel like a mistake until something goes wrong. An unexpected expense, a job loss, a health issue, a car repair you didn't plan for. When you don't have an emergency fund, your investments become your emergency fund. And that forces you to sell at the worst possible time during market downturns, when prices are already low. That's not bad investing, that's bad planning. Before you invest, you need cash set aside, usually 3 months of expenses if your income is stable and 6 months if it's not. An emergency fund doesn't make you richer, it makes you resilient. And resilience is what allows long-term investing to actually work. Another mistake is panic selling during market downturns. Market drops feel painful, but they are normal. Every long-term investor will experience them multiple times. The problem is not the drop itself. The problem is selling because of fear. When prices fall, many beginners do the exact opposite of what they should. They sell low, lock in losses, and then wait until prices recover to buy back in. At that point, the damage is already done. Market downturns are not a signal to panic. They're the price you pay for higher long-term returns. Picture this. If you wouldn't panic because something you want is on sale, you shouldn't panic when markets temporarily drop either. Volatility is uncomfortable, but it's not the enemy. The third mistake from this section is investing amounts that are too small. Starting small is fine because it helps you build the habit, but staying small forever is a hidden trap. Many beginners feel productive just by investing something even if it's not enough to make a real difference. Over time, this creates a false sense of progress. Wealth is not built by occasional investing. It's built by consistently investing a meaningful portion of your income. That usually requires improving your savings rate, your career, or both. Let me show you what I mean. To keep things simple, these numbers ignore inflation and taxes. They're just meant to show the power of scaling your investments. Investing 20 euros per month for 40 years at 10% gets you around 126,000 euros. Now compare that with 150 euros per month. That grows to almost 950,000 euros. And 300 euros per month? Nearly 1.9 million euros. Same market, same time. The difference is not starting small, but it's never scaling up. Investing small amounts is how you start. Scaling those amounts is how you move forward. To finish this section, we have overestimating the risk of investing. Many beginners focus only on what can go wrong. Market crashes, losses, bad years, but they ignore the risk of doing nothing. Inflation slowly erodes your purchasing power because cash loses value quietly year after year. Historically, markets go up more often than they go down, and long-term investors are rewarded for staying invested. The real risk is not short-term volatility. The real risk is staying on the sidelines for too long. Fear feels protective, but over time it becomes expensive. Understanding risk isn't about avoiding it, it's about choosing the right one. One of the mistakes I made early on was confusing trading with investing. I told myself I was investing, but in reality I was just reacting to price movements. I was checking charts too often, thinking about when to buy, when to sell, and trying to be smart in the short term. What I didn't realize back then is that every decision comes with a cost. Fees, taxes, and most importantly, emotional energy. The more I traded, the more I felt involved. But involvement doesn't equal progress. Trading made me feel productive. Investing felt boring, and that's exactly the point. Long-term investing works because it removes the need to be right all the time. Once I stopped trying to outsmart the market and focused on staying invested instead, everything became simpler and more effective. Boring doesn't mean slow, it means sustainable. The 10th mistake is buying individual stocks as a beginner. Picking individual companies feels smart. It feels like you're doing real investing, but it also concentrates your risk. When you buy a single stock, your outcome depends on one company, one management team, and also one business model. As a beginner, you're competing against professionals who analyze companies full-time with far more information than you. Diversification is not boring, but it's protection. Broad ETFs give you exposure to hundreds of companies, so you don't need to be right about just one. Stock picking can come later. First, you need a solid base. Next mistake is choosing the wrong ETF. Not all ETFs are the same. Some are diversified, others are extremely narrow, expensive, or complex. Beginners often choose ETFs based on recent performance, catchy names, or themes that sound exciting. But what matters most is simple. What the ETF holds, how diversified it is, and how much it costs. A boring, low-cost broad ETF will usually outperform a complex, trendy one over time. Simple beats clever. If you're curious to know more, I recommend you to watch this video next to learn everything you need to know about ETFs. The fourth mistake of this section is chasing dividends. Dividends feel like free money. Seeing cash hit your account feels rewarding. But dividends are not extra returns. They're part of your total return. In many cases, focusing on dividends too early can reduce growth and increase taxes. For beginners, growth usually matters more than income. You don't need cash flow from your portfolio if you're still building it. Dividends have their place, just not at the beginning. The next mistake is ignoring taxes. Taxes don't feel important at first because they're invisible until they're not. Every sale, every dividend, every trade can trigger a tax event. Over time, taxes can quietly destroy returns without you noticing. Good investing is not only about returns, it's about what you keep. Understanding how your investments are taxed is part of building an efficient portfolio. What you don't see can still cost you. The second last mistake is paying high fees to banks. Fees feel small, 1% here, 0.5% there. but fees compound just like returns. Over decades, high fees can cost you tens or even hundreds of thousands. Banks and institutions are not charities. Their products are designed to be profitable for them. Low-cost investing doesn't mean low quality. It means efficiency. Every euro you don't pay in fees stays invested and working for you. To finish the video, we have the following mistake. Overcomplicating your portfolio. Too many assets. Too many strategies. Too many rules. Complexity creates confusion. Confusion leads to bad decisions. A simple portfolio is easier to understand, easier to maintain, and easier to stick with during bad times. You don't need complexity to build wealth. You need clarity. Simplicity is not a weakness. It's an advantage.